Joining us right now, Paul Dietrich from Fairfax Capital Markets and Nick Raish from Earnings Scout. What do you make of this rally here?
Well, you know, I actually believe the market is still undervalued. I mean, for the last 8 or 9...
By what measure?
Well, by the last 8 or 9 years, we've been looking at valuing the market based on the underlying assumption of 2% GDP growth. If you look at what almost everybody agrees is going to go through this year on economic policies, regulatory reform, tax reform, cutting corporate taxes from 35 to 15 or 20%, and the big economic stimulus package of an infrastructure, $1 trillion, independent analysts believe that that will get us up, as we were talking earlier, to 3.5%.
But it's funny you say that, because just this morning Jack Bogle came on. He said he thinks the market's overvalued because he doesn't see, even with all those things you mentioned, how growth gets over 2%.
Well, I'm just telling you, the independent economic analysts are saying that we're going to get 1.25% to 1.5% based on the corporate tax returns. I mean, think about it. If you lower corporate taxes from 35% to 15 or 20%, that goes to the bottom line. Those are earnings. And then we know the stock market responds well to economic stimulus.
Right.
So 3.5%, we haven't seen that since the Johnson and Kennedy administrations and the Reagan administrations. And that's why this market is going to look undervalued when we look back.
Nick, what do you think? I mean, especially as it pertains to those earnings that everybody says is the lifeblood of the stock market. As long as we see growth there, we see the stock prices continue higher. Do you see that right now?
Well, the last 2 earnings seasons, including this earnings season, what we're seeing is after companies report, we're seeing earnings estimates for the next quarter out to 2 years into the future falling at increasing rates, and the market's been ignoring this. So based on the direction of earnings expectations 6 months to 2 years into the future, prices have got ahead of themselves. That doesn't mean the market can't go.
Doesn't that always happen, though?
No, but they're falling at increasing rates, Kelly. So what we're seeing this earnings season is the average companies reporting, and 61% of the companies in the S&P 500 that reported this earnings season are seeing their first quarter numbers go down by about 2.7%. Last quarter, they were falling at a rate of 2.2%, and the quarter before that, about 1.9%. So we're seeing estimates fall at increasing rates in the near term.
Even if we see
why
meaningful tax reform, corporate tax reform, whatever form it's going to take, you'd see a decline in earnings growth at the same time?
So there's no decline in earnings growth. Growth is accelerating. First, take it to the bank. We're talking in 2017, the economy is going to be better. We're talking off of expectations which are already high. We just think that they need to be reset a little bit lower to a little less rosy, optimistic scenario, and the prices need to be reset a little bit lower too. Now, the only thing that could be happening is the street might be looking at 2019, 2020 estimates and 21 estimates going, some of these policies from the new administration may take some time to take effect. And in that case, the market's taking it higher. But we say the further you have to go out into the future to justify current prices, the more speculative the market.
Quite a stretch.
All right. Paul, Nick, good to see you both. Thank you for joining us today. Appreciate it.